Good afternoon, everybody. My name is Bora, Varliyagci, as introduced by Andre. Thanks for welcoming us to this interesting session about investment and investors. And we have very, very important guests today with us on the panel. And without them, probably we wouldn't be having this event in such a great and growing momentum year over year, because they provide all the necessary investment and funding which is necessary to get this infrastructure going. Particularly, we are getting into the era where we have heard over and over again towards the discussions on the panel and other presentations. We are getting into the era of data, and we are just at the beginning of it. The data demand is growing, and that puts a lot of pressure on the networks, because networks historically have not been designed and operated in a way that the data is growing and meet that demand today. So we need to invest more on the networks to meet that demand, and there is a lot of drive over there, including the fiber and other technologies such as 5G we are talking about, as well as the impact of it from data point of view, how we deal with data, how we deal with the networking requirements. We are getting to see data centers becoming more and more important. They are coming closer to the end users. We are talking about proliferation of the edge data centers. So within that context, I guess the investment and infrastructure and what happens on that infrastructure becomes extremely important. So we are here with our panelists today to hear their thoughts and experience in this growing demand of investment on the continent and the lack of it somehow as well. So first of all, I'll start with the introductions. I will let our panelists to introduce themselves. We have Keith from RMB, Brandon from Convergence Partners, and Permission from APSA. So I'll request from them to introduce themselves, their interest on the market, and what their organization do from an investment and funding point of view. Starting with you, Keith. Yeah.
Thanks, Bora. So Keith Webb from Rand Merchant Bank. I sit in the investment bank. We focus very much on the debt funding side of things, always starting with senior debt, working our way up into the mezzanine. We don't typically fund equity. We've got partners that we work with who fund the equity. But in terms of the sector, we have funded pretty much not only the big operators, but also the new emerging tower companies, the fiber companies. One or two looks at data centers. They're not that big in South Africa just yet. There's not much of the sector that we haven't had a look at to try and find a way to provide cost-efficient and bulk, if you will, senior debt funding in there.
Brandon Doyle from Convergence Partners. So I'm the equity guy on the panel. We private equity fund manager operating across the whole of sub-Saharan Africa with a particular focus on tech, and within tech with a core focus on infrastructure. So the last panel we had Fiberco and Seacom here. We were early stage investors in both of those businesses. Dark Fiber Africa, Vumatel. We're building out fiber together with Google in Uganda and Ghana and now Liberia through a thing called C Squared. Doing wireless deployments here in South Africa via a business called Comsol. So the network layer and the infrastructure is very much core to what we do.
Good day, everyone. My name is Permission. I'm from APSA Corporate and Investment Bank. We're a Pan-African financial institution looking predominantly at debt financing solutions, and that extends from your typical corporate type debt solutions to more structured solutions. In the past, we have looked at some equity situations, but APSA took the decision many years ago to exit that type of business. However, I think as we look at many new opportunities, it certainly lends itself to more innovative ways of coming up with financing structures, and there are one or two situations that we're looking at where we're testing the extremes of mezzanine financing or subordinated debt with certain equity characteristics, and I think it's quite important for a financial institution to start thinking along those lines, given that many of the opportunities that require financing going forward are smaller opportunities and probably testing the limits of what is possible from a senior debt perspective.
Thank you very much, and once again, welcome. I guess I will start with discussing a little bit about the technology developments. We talked about, in my opening as well, I talked about growing infrastructure requirements from technology point of view. It involves, on the wireless side of the things, 5G technologies as well. And we started to talk about a lot more about artificial intelligence, augmented reality, and these concepts are becoming reality. We are using indeed, sometimes without being aware of that we are using them, but this is already part of our lives. And I just want to ask you what your views on these technology developments, how the investor community should be viewing these technology developments. Is it a threat? Is it an opportunity? And what is your view on potentially the investment required on these drives as well? Because infrastructure is part of it. But once it is deployed, then you start to see new creative businesses or lots of entrepreneurial type of developments that's going over there. And what's your view on these developments and required investment over there? It's not as obvious as infrastructure always. So what's your take on that? Maybe starting with Brandon.
Sure, Bora. Yeah, so I think start with the middle part of your question about whether it's a threat or an opportunity. I think generally we think these emerging new technologies present a tremendous investment opportunity for a firm such as ourselves. But I do think that the economics of these new opportunities as they emerge are going to play out in different ways for different participants in the market. So I think at a pure infrastructure layer, what we are seeing generally across the board in many of the markets that we're in is price deflation is happening, and it will continue. One hopes, I guess, is in terms of the pure infrastructure side of things, that we'll continue to see the uptake of data services on the back and boosted by some of these new technologies and new applications will grow the demand curve for bandwidth at a faster rate than the price is deflating. But I think that will inevitably come to an end. So I think there is a threat for sure in being a pure infrastructure player in this emerging new world. And what we are looking at are businesses that have an ability to kind of pivot their position or at least take advantage of these opportunities as and when they arrive. And that's taking advantage in terms of the architecture of a network or the commercial relationships of a business in the market or being alive to the types of global relationships one needs to be able to take advantage of what's happening. We're seeing a huge change, I believe, in the way in which people interface with technology in terms of the cloud. For many, many years, I think we've been looking at cloud as if it's kind of something that's out there and maybe will happen, and do the economics work for Africa, and is there enough compliance with software licensing to make it work? That conversation we see is changing very, very rapidly right now. And on the back of that, the emergence of the hyperscale global cloud players, the Googles, the Amazons, are really starting to play a very, very significant role, even in the communities that we're in, either as co-investors with us into networks or as partners in terms of bringing product to market. So I think the opportunity set is there, but I think trying to be an island in those opportunity sets without having these global partnerships and relationships and kind of points of understanding as to how the business models need to change to take effect or give effect to these new opportunities, I think that's the problem. We're seeing a number of pitches across our desk where people are trying to develop an AI solution which is so bespoke and so unique and so divorced from what's happening around. That's really difficult, I think, for those guys to A, get the capital, and B, actually get those opportunities to commercial reality. So to sum up, Bora, I think the opportunity is there, but it's got to be seen as part of a globally integrated community rather than kind of isolated pockets of opportunity.
Keith, your take on that?
Yeah, so I mean, we do see these as opportunities, whether rather than threats. We do look at when we are funding how any opportunity that we're funding is protected against changes in technology and is relevant. And the case in point is the fiber to the home business. where whether you go 5G or fiber to the home, we still think the densification of fiber networks is required and absolutely needs the funding. And that is quite an advanced discussion you can imagine for a credit committee who is funding across the entire South African economy. So I try not to push our credit committees too deep into the detailed technical discussion. We usually invite experts like yourself to come and address those sort of things. But just to comment specifically on your question, would you find senior debt funding in a new Internet of Things type of opportunity, or we actually had a look quite extensively at sort of a fintech type of idea, which is sort of closer potentially to our banking business. And the reality is it's a very difficult space to provide, as I say, senior debt. One way we do look at these type of opportunities, and I think it's pretty much like Brandon would be doing, is to look for management teams that are able to create platforms, create investment vehicles that will have a multitude of opportunities, some of which are more stable sort of infrastructure type opportunities and data centers potentially, and then moving into the more exciting sort of value-added sort of software, etc. type services. But it's very difficult, in summary, to put senior debt into those software type services.
Permission, do you share the view? I mean, is it the same on your side as well?
Yeah, I think the typical commercial banks face similar challenges. I think there's probably a few issues to raise. One is that the rate of the technology evolution is so rapid that if you're taking a long-term debt position in a particular technology, you have no assurance that it will not be disrupted. So I've often had the debate with people in my credit committee and others in the bank around whether or not 5G is a threat to fiber. So I think these are typically well-publicized technologies, so people pick up little snippets and suddenly it's the next big thing, and how does it then impact on a current position or a future lending position that the bank wants to consider. So the threat of obsolescence is something that needs to be well communicated, well understood, right? And obviously considering the mitigants around it. So some of the other issues you've raised in terms of technology advancement around AI, etc., and fintechs in particular, I mean, that is something that we've looked at as an organization. We've taken one or two, let's say, brave punts on some of these, particularly where it comes to, for example, like micro-lending. And I think as a financial institution, again, the point I raised earlier was that you need to try and come up with innovative solutions and try to be part of the technology evolution.
It's interesting because, I mean, we are somehow deploying this technology and networks to kind of stimulate innovation on top of them. That's where you get the value after all, because otherwise the network that you lay on the ground doesn't mean anything if you don't make use of it. So in the absence of, this appetite or, stages of getting to a senior debt facility at the beginning, so what are the, steps on this? At what stage businesses should be looking for equity versus senior debt? And on that equity, I mean, in your opinion, is there enough facility on the market from a venture capital point of view in South Africa or in Africa in particular? Because most of these early stage developments and innovations typically require that kind of funding. And in other markets, it's more, structured, more available, lots of alternatives are there. What do you think is the situation in Africa and how we can go about it? Probably starting with Keith.
Yeah, I mean, banks are pretty much on the totally the other side of venture capital. Venture capital is taking absolutely, brand new business opportunity risk. The conversations that we have with people, that is not what a bank is there for. It's not designed for that. I was taught banking the first day that I arrived there by a colleague who said, banking is all about not losing money. When you are earning an effective 1% margin, if you lose money, you take 100 years to make it back. So, new opportunities, new business models, unproven, and it's not the right time to approach a commercial bank. That said, when a business has proven its business case 2-3 years down the line, it's got some sort of track record. We do look quite seriously at how to scale that business, how to inject capital and scale that business. The one place where we certainly think very hard as RMB is us as a corporate and our needs in the, for instance, fintech space or the telecom space. And how can we use our demand, our need to actually start up these type of businesses? And to that aim, we've got various incubators that are sit very close to us, trying to solve RMB or first rand business problems. And that's the way we can manage the risk, because we are the risk, we are the market. So that is certainly a successful incubator that we've got running.
Brendan, do you take these early stage risks? Do you go as an equity player at early stage investments?
Yes. So we invested pretty much across the life cycle, from pretty early stage right through to kind of late stage, still with a growth capital mentality. So we tend not to do classic buyout style deals. It's more injecting new capital into businesses to help them grow. On the debt side, it's interesting for us because it really differs. Our use of debt as an equity shop, obviously it's important to us because it's what generates good returns for our equity. But we tend to look at it on a case-by-case basis, depending on where the opportunity sits geographically and what's the nature of the opportunity. So yes, we have, for instance, used significant debt raises in very early stage opportunities, but much more with a sort of a project financing mentality, things like CCOM, Fiberco and the like, where we're able to lay off significant risk right from the get-go, whether it's via turnkey contracting on the actual build or significant customer pre-offtakes. Then you can use debt, I think, in early stage infrastructure. Otherwise, I think it's, to Keith's point, very, very difficult. And then from a market point of view, I think in markets outside of South Africa, it's really, really difficult, even in quite mature businesses, to raise debt in those markets themselves. There's just not a depth of credit in those environments, and the cost of debt is very high. So we tend to invest primarily equity when it's on a non-South African play, and then bundle assets together to get to a platform that then is of a scale that within the platform we can raise debt facilities. So that's kind of been our approach to date. In my mind, I think what our industry is lacking quite severely is a deep and liquid mezzanine market. So there are mezzanine players out there, but in many respects they are more junior equity, and they're charging rates that are like junior equity rates. But really, that sort of more subordinated debt layer is what's somewhat missing, and something that needs to be addressed going forward.
Interesting. Permission, as far as I know, you guys do not have an equity play, but how do you then balance, your approach to this? Are you being left behind? What's Absa's approach into bridging this, early stage to later stage? Because if you come too late in the game, you might be, going against other investors as well. It's difficult to capture ground. What was your strategy, and how do you deal with this risk and developments?
Yeah, so Bora, I think the basic principle is that the business is ready for debt when there's cash flow generation which is able to support the interest and capital repayment. And to some extent you can structure in an interest and capital repayment holiday, but that's not going to typically be longer than a year or two at a stretch. And to the extent that you're able to get that capital and interest holiday, there needs to be other mitigating factors that the bank can take a view on. So the first principle is cash generation, and that would then typically rule out very early stage investments, which is, I guess, more suited to an equity type profile. But having said that, I think there have been some situations where you're able to structure in a mezzanine profile given the very strong growth in that type of business. But there has to be an element of that business model being proven, because you do not want to structure in subordinated debt type features if a business plan is particularly aggressive, and if there's any risks in terms of achieving that business plan. I think in addition to sort of the cash flow, it's first principles in banking are look at the management structure, the people behind the management, do they have the proven capability, etc. And then of course the shareholders and the balance sheet that the business has got access to.
I might want to comment actually on what Brandon was, the sort of challenge that you put out there in terms of the mezzanine side of things. An area we see not all opportunities, early stage opportunities, come as project financing. Sometimes you're not able to have contracted offtake, and that becomes a challenge where you can see, for instance, fiber to the home type business, you don't have contracted offtakes. How do you inject that capital so that you can actually roll out that fiber? And what we've done, and it's probably a little bit too early to really talk too much about it, but with players in this room, we've put together a huge mezzanine facility where we're taking a view that they will grow into that. With the idea of capital graces, almost quasi project finance where we're banking the rollout, knowing that there is a moat around it, the famous moat. It doesn't make sense to roll out a second fiber network in this instance. So you're fairly protected in your investment. So it's a little bit of a stretch. You can see bankers sort of tears. But we certainly do that for what we call key sponsors, key clients who, if things don't quite pan out as projected, are able to provide some level of balance sheet support. It's not with the mindset of a full non-recourse. We expect sponsors to back their plans, but we certainly are, in that context, able to put bulk funding up front for particular capex investments.
Thank you. I mean, it's interesting though, because we have, this technology developments happening so fast, and what happened in South Africa within the last 4 years on the fiber to home game. I mean, everybody saw the opportunity, went out there and start competing, land grabs and all. And on top of that, then you have this fixed wireless drive, 5G coming in. Is fiber the right approach? Can we go fixed wireless? And probably we are getting approaches from all these players, sometimes competitors to each other, sometimes competing technologies coming for the funding at the same time. How do you deal with that complexity? How do you make your selection and decision on these opportunities? Probably starting with permission this time.
So I think we work on the basic premise that there's rational competition. And I think certainly in the rollout of fiber, we've seen a level of irrationality in certain areas. And you combine that with this overhanging threat of disruption, it certainly does become a massive challenge. And I think it goes back to the earlier points that we've made, in that is this a management team that you can take a view on? Is there a balance sheet? Is there a business plan reasonably robust? Is there strong cash flow generation? So you would not look to extend debt unless you can tick all of those boxes.
Brandon?
Yeah, Boris, I think our position is a bit different to banks in the sense that we sit on the boards of the companies that we invest and provide strategic direction. So conflict of interest is a critical issue for us, and we have to be cautious as to who do we pick to back, because you can get into those conflict positions quite quickly. We heard in the previous panel how businesses are starting to bleed into each other's territory, and that's an inevitability in the market, frankly. So we are very cautious about who we back. And to Ramesh's point, and I think Keith made the point earlier, it starts with the quality of the management team. Is it a backable group of individuals who know what they're doing? We have a very clear, focused view from a business plan point of view that's believable, that's backable. And frankly, we start off with a position of, in backing business A, is it a business that can scale and that we can help scale to become the market leader in its space? And that's generally how we've built out our portfolio to date. We do get quite nervous about players who are looking to occupy a very niched area of either whether it's geographically from a market-facing point of view, or just in terms of kind of backing a single technology solution. So we do like diversity in kind of management teams and a proven ability to kind of pivot into different opportunities as they present themselves rather than being fixated on one thing. But, and it's a bit counterintuitive, aligning that also with a very focused and driven approach. We tend to like businesses that are able to articulate what it is they're trying to do with one or two key metrics and then demonstrate and prove that they're able to deliver against those metrics. You know, because you get, and I'm sure these guys are the same, you're getting opportunities crossing your table many times a week, and you really have to narrow those down and select the few that you're looking to pursue or looking to investigate in a more deep way. And it's critical that there's a believable business plan, a believable management team, and a focused way of describing and articulating what the business does.
So for us, you know, as banks, we don't sit on the boards. We don't get to see the strategic insights and the sort of sensitive topics that boards will be talking about. So we tend to, and I guess we have to fund the sector. We can't. We try not to cherry pick particular opportunities. No, we'll support this technology, but not that technology. The nice thing with that is that one does get a fair amount of insight across the sector. So when the fiber player comes to us and his business plan says that he's going to get 100% take-up, and the 5G player comes and says he's going to get 100% take-up, well, you know, there's obviously, you know, somebody's lying, right? So, you know, we can, as long as there's a consistency in the sort of sector themes, if you will, or insights, we don't have a problem placing senior debt funding in multiple parties. There was another point I wanted to make around it, but I think let's move on now. Sure.
Can I maybe just extend on that point? I mean, I think, you know, there's a obligation on the banks to obviously be supportive of the country, be supportive of the economy, etc. And I guess this, you know, it's well documented that, you know, enabling connectivity is effectively enabling the growth of the country and improving the GDP, and we all know that we certainly need that in SA at the moment. But it's also particularly difficult because, you know, how do you know which is the right project? Especially where you have multiple competitors, competing technologies, and perhaps a different approach to providing that connectivity. And I think the challenge in the sector is well evident because there's been distressed credits in the market, right? So it's very difficult for the financial institution to take a debt view when many of the boxes in terms of proven capability, robustness, etc., are not ticked. And by the same token, there's, going back to my point, there's also this obligation that you're always trying to meet.
Sure. I remember the point I wanted to make. One of the things that I certainly like about the fibre sector is that I think there's a lot of headroom. There's such a need for that capex that I think we're so far away from you know, that sort of should we invest, should we not invest. I just think, you know, my point of view, when I go to my credit committee, I say we need a fibre down every road in this country. We are so far away from that, you know, I don't think that's going to be the problem.
In terms of, I mean, it's interesting because in terms of your portfolio, investment portfolio, obviously, you know, you have considerations in terms of type of assets you have, type of geography that you are exposed in. Is it ever becoming a barrier in, you know, supporting and investing in a good opportunity? Brandon? Is your diversification of your portfolio, I mean, are you facing a situation where you feel that I'm exposed so much in this particular country, I cannot take any more, you know, risk, and how do you go about it? It can be country, it can be, you know, type of asset that you are investing in. So what are your considerations over there? Or is it ever becoming a, you know, barrier?
Yes, it is, Bora. So as a private equity fund manager, some of what we do gets dictated to us by the people who provide us our money. In our case, it's mostly the global development finance institutions, and in reaching agreement with them as to where we're going to deploy that money, they obviously would like to see, as development banks, their money being used where it's going to cause most impact. We are impact investors in the sense that we look to making sure that what we do has a positive impact, not just from a financial return point of view, but in terms of a social impact. So we have a mandate to fulfill from our investors, and that does then constrain us both from a geographic point of view as well as from a technology point of view. So we can get to a point where we overweight a certain economy or we overweight a certain technology. I think where things are going from a technology point of view, more and more we're seeing businesses that are investable, that are much more multi-tech in their approach, which frankly is a model that we favor. I think there is going to come a point where large open access wholesale providers need to really think about not just only being a fiber provider or only being a wireless provider or only being a wireless provider using this type of wireless technology, but actually coming up with use cases for different deployments that make sense for the needs of that particular market or customer. And so it's less of a constraint to us from a technology point of view, but definitely from a geographic point of view.
In terms of debt, on the bank side, probably permission.
I think there's probably enough opportunities out there that at this stage we don't necessarily need to become overly concerned around concentration risk. But having said that, I think there's in the fiber space in particular, we've seen many very small operators who've been able to go through the regulatory process and are ready to start their build program, and they're looking for a debt solution without having necessarily secured the equity or or sufficient equity to support the project. And in those particular types of instances, unfortunately, it's just not bankable, because effectively the bank is being asked to take a view on what is probably an optimistic business plan and a significant element of market risk. And for example, if that business plan is predicated on 50% take-up level and you only get to 20% in 6 months, effectively that business is probably going to run out of road and run out of cash before they're able to fully deliver on the business plan. And that's certainly not a position that the bank wants to find itself in. So I think it's not necessarily an issue around concentration risk, but it's more an issue around supporting the right businesses which probably have the best likelihood for success.
Yeah, no, I'd agree with that. I mean, you think certainly about the banks in South Africa, we have very diverse portfolios, not just in the sector, and obviously our credit risk team are looking at the portfolio across country, across sectors, and it's certainly not a problem that I think about. If there is good opportunity and we as RMB are not able to hold the full amount of that opportunity on our balance sheet, we'll bring friends in. Good opportunity, everybody wants a piece of that, and whether that is the fellow banks or capital market players, that's almost the role that banks are increasingly playing nowadays as a conduit to the savings industry, end to end, to fund good opportunities.
I think also maybe to extend on that point, Bora, the reality is that there's a significant amount of capital that can be deployed to the sector. And it's not just the banks looking at taking debt positions. There's a number of fund managers, etc., who have a mandate to invest in the sector and a significant amount of capital that they can deploy to the sector. So I think our challenge right now is not that we run out of capital because of concentration risk issues.
That's interesting, because I mean, at the same time, I mentioned about the geographic diversification as well. And one challenge or one observations that I have on the market, on my engagements, is the pace of regulatory developments in the countries, because everything is moving so fast. By the time regulator caught up with what's happening, everything moved again. So, I mean, do you see regulatory issues and political risk on top of it going on the continent as a major risk, and what are the other risks that you take seriously in your decisions? Brandon, maybe with you again.
Yeah, the regulatory risk is a very, very critical issue. I think for any investor, whether debt or equity. And the truth is, and it operates at two levels. One, is there a regulatory regime in place that is bankable, frankly? Does the business model that you're looking to back fit in with the regulatory framework of the particular country? But almost yeah, in these liberalized markets now, the regulatory frameworks are starting to become relatively similar. The bigger issue then becomes one of enforcement of those regulations. And that's a very critical issue. Even here in South Africa, you've seen a number of businesses come to the fore where there was some deviation, I would say, from what was the established regulatory framework, but yet those models have been able to be passed and thrive. We tend to avoid that type of investment and stick to things that are within the regulatory framework, in the hope that ultimately there will be capacity building within the regulatory space to enable regulators to do what they ought to be doing. The real challenge now is that with what we faced with, particularly here in South Africa, with the new bill coming through and ultimately finding its way into legislation, is that if anything, the regulator's job is becoming much more complex and much more difficult to police and difficult to enforce. And my fear of these complex set of regulations, whether it's around the WOAN or spectrum sharing or moving into 5G and the like, is that these things could all be stillborn unless in some way, shape or form the regulator gets recapacitated. And I don't see that really happening unless the industry itself weighs in and starts contributing in a meaningful way to helping with that process of creating more capacity within the regulator. But I think this is, to me, is the critical risk issue facing providers of capital going into the sector. In a rapidly changing environment that's getting significantly more complex to police, you have to have strong regulators to be able to do so.
Yeah, I would totally agree. I think 2-3 years ago, regulatory risk, I would have said, is not an issue. Most of the African markets that we work in had very advanced regulatory frameworks or international frameworks, and then it was more about the commercial case. If we build it, will they come, etc. I think of late, regulatory risk for me is the single biggest issue that we face on the continent right now. I mean, between this conference and the next door conference, we've got the various players talking about various countries where suddenly telco players are big corporates in that environment, and that they look like a suitable source of revenue. And I think it's a risky game that regulators and governments are playing at the moment. Almost attacking the various players. It certainly is something that we notice as funders, and we are going to hold back. There's a risk that we are not sure how it's going to pan out in various markets, and that's across the board. That's not one country, not only South Africa or West Africa, etc.
Permission, do you share the same views?
Yeah, absolutely. I mean, the point you raised and what we discussed earlier around, the rate of technology evolution, I think it's so rapid that in certain respects, the regulator and the policy developers are trying to figure out what is the way forward, right? And let's assume for a moment that, they have the best intentions. And then it's a case of how do you balance the interests? Ensuring that there's continued investment in the industry, which means that it needs to be reasonably attractive for the primary providers of that capital to actually take those positions and invest, right? So you want to encourage that investment as a regulator, but at the same time you want to ensure that that the service is as widely available as possible at a price point that meets the requirements of the users of that service and the best interests of the economy. So trying to, I guess, manage the different interests, and all of these interests are quite well vested, is a massive challenge for the regulators, and particularly where the regulators are not on top of where the industry is going and some of the future challenges, let alone the current challenges that they will still have to deal with in coming through. Maybe a very good case in point is, we've been going through the debate around the allocation of spectrum in South Africa, and that's predominantly in the 4G space, and already we're talking about 5G. So are we going to get to the point that 4G spectrum is never fully allocated before there's a new range of spectrum debates, to satisfy the new technology developments? So ultimately, I think as a lender, a stable regulatory environment is absolutely critical. And in the absence of that, I think it does impact on an investor's decision whether to support that industry or not. And I think maybe an extension of that is in terms of a regulatory risk in other geographies. And we've seen many instances where, apart from the recent experience in West Africa, in other markets where the regulation framework actually does not cater for the specific issue.
I guess, we are almost at the end of our time, I guess, but I want to conclude the session with one final question. I guess everybody is thinking, if I need money, what do I need to go to this gentleman with? What would be the top 3 considerations that you are looking at an investment opportunity? And within that, is there a sweet spot in terms of the deal size that you would be happy to look at? Starting with probably Keith and
top 3 things. I would say a bankable, it might sound silly, but not a bankable business case. I think, ideas are great, and, to get a 25-page business plan is wonderful, but you have to have proven it, and have some sort of track record, or have contracted offtake, as Brandon was saying, before you approach the commercial banks for senior debt. There are certain instances where we will, as I say, fund mezzanine on an early stage, and that is for key sponsors. So guys with balance sheet who can, weather various storms. So what would I like to see? I would like to see a bankable business. It's established, it's proven. I'd like to see a management team that has got a lot of experience in the sector, and is well incentivized to deliver any future business plan. That's 2, but that's probably enough in those 2.
in terms of deal size?
Deal size, if you, depending on the structure, the project structure, if it's a project financing, anything under R1 billion just doesn't make sense because it's a very detailed technical structure, costs a lot to put in place, so anything under R1 billion doesn't make sense. But then, depending on the opportunity, you might get down to the sort of 250 million rand. It's certainly worth our while taking a look. But again, key sponsors, we'll roll out the red carpet for whatever their needs are.
Thank you.
Yeah, so I think if you sum up all the discussions we've had here, it's really been about the changes that are coming in the market. And I think, so the first thing for us, and whether those changes are going to be from a regulatory point of view, a technology point of view, a business model point of view, change is accelerating right now in our space. So the first thing for us when we're assessing opportunities is to look at, I said earlier, the quality of the management team, but also the proven ability of that management team to pivot their business model through this change and take advantage of the change. And that kind of agile approach to being able to shift the business as and when the market circumstances dictate so. And a number of, Seacom's a good example of this. There was a discussion in the earlier panel about how Seacom's moved from being principally an international carrier to providing services on the ground in some of the markets that it lands in terms of enterprise services. A management team that is able to do that, to kind of stretch themselves and stretch the business. That's first and foremost for us. Secondly, I think it's aligning the business plan to a believable market study. Very often we see business plans put in front of us where they've got the typical hockey stick projections, and when you actually apply any form of logic test to those hockey sticks, guys are predicting that they're going to have like 80% of the share of the segment of the market they address within 4 to 5 years. That to us is just not kind of believable, and it starts with, does this opportunity, do these sponsors, does this management team, do they demonstrate that they understand the market that they're going into, understand the scale of that market, and realistically what size of market share they can get within that market space. And again, often we see these business plans that starts off with ICT spend in a whole country and kind of narrow it down. That's not to us a market study. A market study is really starting with the market segment that the business is in and what share of wallet realistically can the business get in that particular segment. So that's also critical. And then going back to the first point, I think the third really is not again just the ability to pivot, but a management team in a business that actually exhibits the fact that they understand what these changes look like. What does 5G mean to their business? What is IoT going to do? What is the cloud, the impact of the cloud on their business? And understand that world that they're in. Because again, there is a lot of business plans we're seeing at the moment that is just kind of also rans. Well, it worked for these guys in the past, so we'll just do the same as these guys. Whereas I think the complexity and the difficulties of the market we're heading into dictates that you need a fundamentally different approach and a nimble, agile management team. In terms of sweet spot investment sizes for us, we typically, from our own balance sheet, we're in the sort of $10 to $40 million range from an equity point of view. But with the investors that back us, we often put together kind of co-investment consortiums to do much larger ticket sizes than that even.
Thank you. Permission, last words on you.
Yeah, Bora, I think many of the points have already been covered, but I think just to emphasize that capability and the demonstrated ability to execute on a business plan up until that point is absolutely critical. I think maybe just to take a different angle to this, especially with smaller opportunities, the concept of strategic partnerships should not be cast aside, because I think that can be absolutely critical to helping to get funding for a business plan, which may not necessarily have the demonstrated cash flows or the level of equity that a typical commercial bank would require. So that is just something that I think should be an open consideration. And I think there are a number of private equity type funds who are quite keen to get involved with certain early stage developments. But then, as Brendan says, I think there's a number of key points that need to be met. You asked a question around sort of the deal sizes that we would look at. I think we've been fairly open-minded because we've seen some really good business plans with a huge amount of potential, looking for between 50 and 100 million rands worth of debt financing. But I think the sweet spot is definitely multiples of that. So the scalability of the business is actually quite key, and generally if you're looking for funding in the order of 500 million and above, you've achieved that level of scalability that already proves that this is a viable business.
Thank you very much. I think we can go on talking about this endlessly. It's a very interesting topic, very relevant to the market as well. I'd like to thank you for all your insights. And with that said, I want to hand it over back to Andre. I'm not sure if we have any time for questions, but I'll leave it to you.
Thank you. Yes, it is running a bit low on time, but we do have one question. Andile, perhaps you'd like to shoot?
No, I won't shoot.
Are you? There we go.
Here we go. Thanks. No, I won't shoot. I'll ask you. No, here's my question. We don't have to answer it now. Maybe we can answer it during. The question I'm asking is, I understand this regulatory blockage, if you want, or challenge we have over time, which has created problems in terms of investments, in particular in the last 10 years of 4G. I want to throw the question maybe in another way. I think in economics we are taught, how monopolies behave, how duopolies behave, and how oligopolies behave in the market. In any market, we know these theories, we have seen this. Don't you think that, there is an element of that in our markets, basically? purely, just a certain type of behavior based on the structure of the market, and those would then find themselves occupying quite significant market power, basically, in the market. That's the first part. The second part of the question is, banks are very good at syndicating, certain types project. It's a common, phenomena that you see in the financials, in the banking environment. If there's a big project, people are able to talk, to tackle it. Is there a way to create a conversation that could be facilitated by financial institutions around this aspect of, I'm going to borrow this term from the banks, of syndication in infrastructure building? If I use a word which is what we call sharing in our industry, because, is it not really a double-edged problem we have? One, at a regulatory level, but where we can work together, we are unable to. We're unable to syndicate, basically, in a lot of these heavy lifting capital infrastructure projects, right? Because of this, oligopoly type structures we have, that some people are unable to sit on the table. How can you as financial institutions facilitate the conversation, basically given all these new technologies of cloud and high connectivity, hyperscale and, infrastructure that is required with, this two-tier model of big guys and mid-sized organizations to coexist in as far as fundraising for capital projects?
Well, I might take a first crack at the first part of that question. The significant market power, what is it, 10 years ago, or maybe a little bit longer, Telkom was the only player on the block. And then, of course, the GSM players came in and sort of outcompeted them. You can imagine that when the cell phone companies were coming in, there was a lot of capital that flowed from banks into those players. And now you have, a duopoly, or maybe you can take Telkom in there as well. If you look at where we are certainly spending a lot of our time is on the new players, on the smaller fiber players. It's all relative, Dark Fiber Africa, Vuma, these sort of guys. And we are absolutely injecting capital into those growing businesses, which become successful, and then effectively, I guess you might say that they become duopolies or monopolies at a further point in time. But for me, the sector is still very competitive, where you'll have these new players coming in and eating the lunch of the incumbents to prove new business models, etc. So I think it's fairly healthy, in my view. The bank syndication, maybe I don't quite understand your question, but I think, again, for me, for a good opportunity, there's no shortage of capital. If from a regulatory, a Reserve Bank point of view, if we are only able to hold a certain amount on our balance sheet, we'll absolutely bring partners in, and I've certainly been involved in deals which have run through the Dark Fiber Africa as an example of this, where we started off on an early stage project financing, injected capital, and it matured. And matured to the point where we could bring other funders in, capital market players. So now, instead of 2 banks, we have, I think, 7 funders in there, and that to me is a wonderful progression of that business. I'm not sure if that answered your question on your second question, but that's my take.
Yeah, I think in terms of the regulator point, Delia, I made the point earlier that there's vested interest, and unfortunately, I think the reality is, and we see it quite often in the press, if there's any potential legislation that attacks the incumbency, then there's always the threat of, well, we're not going to invest and we're going to retrench people. And that suddenly then sways the direction in which the regulator moves the conversation. And it's not generally helpful for competition in the market. But the flip side of that coin is that to some extent it continues the level of investment that the incumbents continue in that particular market. So that's a real challenge, and I'm not sure what the answer is to that, because you need the big balance sheets to take the brave positions and inject significant levels of capital to continue growing that particular industry. But it certainly does, and I think that's well demonstrated in South Africa, that it comes at the expense of competition and perhaps better pricing for the end user. So if you take concepts like the asymmetric termination rates, etc., that should be a no-brainer. It should have been dealt with many, many years ago, but it hasn't because of the very strong arguments that have been put through around the need to demonstrate a particular return on capital. And I think Bora made the point, Brendan may have made the point earlier around the capacity of the regulator to actually deal with those sorts of very challenging arguments and situations. In terms of the syndication question, I mean, maybe just to respond to that with an example, there was a particular transaction that was taken to many of the banks, and we were the only bank that had a level of interest in it. And what we realized was that we would not be prepared to take on the full risk, so we brought in a DFI partner, but we did a lot of the structuring work and the solutioning in the background. Now, it turned out that that was a very challenging project, and we're trying to manage through that situation right now. But again, I think it goes back to many of the points that we were discussing earlier. For exactly that reason, banks tend to focus on the risk mitigation well in advance of a particular lend, because when you end up in a difficult situation, it takes months or possibly even years to extract yourself out of that situation.
Yeah, maybe just a few thoughts from our side. Andile, if I understand the syndication question is more about adopting a similar model to what the banks do in terms of syndicating out facilities to telco operators thinking about how they should engineer their businesses to share infrastructure and do that on a syndicated basis. Look, I think this is a difficult question for this panel to deal with, to be honest, because investors and debt providers actually quite like oligopolies, monopolies, and sustainable cash flow, easy to back businesses. So what's in our own best interests is maybe different from what's in the best interests of the country. And those are two different things. I think if we look at it in brutally honest terms, here in South Africa, we still have extraordinarily high costs of data, and we still have an unacceptable lack of penetration of broadband into rural communities. And this is a real issue, because if one accepts the increasingly coming to the fore narrative that that broadband is a utility, and frankly it's something I agree with, then the business model needs to be addressed to enable new players to emerge that will address these challenges. So things like, and I know it's been hammered in the press and been hammered by the mobile operators, but things like the WOAN, I think are some of the levers, the only levers left to policymakers in South Africa to try and start addressing these problems. So you do have to see the emergence of new business models to tackle these things. And the critical point is that I think it's well recognized the economic impact of broadband penetration, what it can bring in terms of GDP stats. But I think if you go one layer deeper than that, in African economies, broadband can also provide a significant cure for previous social deficits. So whether it's in education, financial services, government services, agriculture, logistics, security, across the board, tech can solve for a lot of these challenge statements. But you can only achieve that if you can get that tech at an affordable price point and an acceptable quality to the markets that it needs to get into. So to that end, Andile, your question about is there some degree of failure in our market because we've seen these major players coming to the fore and dominating the market, and then also not trying to extract any benefits from shared infrastructure build and shared spending, I think is a great challenge and something that needs to be addressed. I'm not sure the banks in the private equity market are best placed to do it, but I think the issue is real and it needs to be dealt with.
I guess if I may add some few words on the regulatory side of the things as well. It is challenging because sometimes we do take action, we see governments taking action without understanding what the underlying problem is. So intervention can be in many forms. You can intervene in supply side or demand side of the thing. So I guess the assessment of where the problem lies before we go ahead and act on it is extremely important. And in recent some of the engagements that I had, I mean, we have seen regulators, introducing the licensing framework that supports all the open access private investment on open access type of networks. And you want to do that, then at the same time government goes and launches their own network and doing the same thing. I mean, obviously it is a very, very challenging situation. Then, whatever you are trying to do doesn't really adds up. So understanding and analyzing the underlying problem and where you need to intervene and what the market developments over there are extremely important.